What if your money could work harder than you do, every single day, without breaks, without complaining, and without limits? Imagine waking up one day and realizing that your money has quietly been multiplying, even while you were busy working your 9 to 5, enjoying your weekends, or sleeping peacefully. That's not a dream. It's the reality of stock market investing done right. And in this video, I'm going to show you exactly how to make money from money through the power of intelligent investing. And if you stay with me till the end, I'll reveal a long-term investing strategy so simple, so powerful, that it's used by some of the smartest investors in India, and yet most beginners completely ignore it. Let's begin. So here's the truth that wealthy people understand. They don't work for money. Their money works for them. While most people chase higher salaries, promotions, and side hustles, the wealthy focus on building systems that earn money independently, whether they're working or not. And the stock market is one of the most powerful wealth-building systems on the planet. When you invest in a company, you're not just buying a stock code. You're becoming a part owner in a business that sells products, generates revenue, pays dividends, and grows over time. And your money becomes a silent partner in that growth. Now let me show you why this is so powerful. Let's say you invest 1 lakh rupees into a portfolio that earns, say, 12% a year. In the first year, you earn 12,000 rupees. Not bad, right? But here's where it gets interesting. You don't withdraw it. You reinvest that 12,000. So next year, you're earning returns on 1,12,000. And the year after that, it's more. This is what Einstein called the 8th wonder of the world, compound interest. Over 20 years, that 1 lakh turns into over 9.5 lakhs, without you adding a single extra rupee. But most people never see this growth because they never get started. Or worse, they treat the stock market like a casino. They gamble, they speculate, they panic, and they lose money. So how do you do it the right way? Let's break it down. There are 3 primary ways you can invest in the stock market. 1, buying individual stocks. 2, investing in mutual funds. And 3, using index funds or ETFs. If you have the time and interest to study companies, then individual stocks can offer higher returns. But they also come with higher risk. To succeed here, you need to understand the business behind the stock. Ask, what does this company do? Does it have a strong brand, consistent profits, low debt, and future growth potential? Now, if you want a more hands-off approach, mutual funds are a great option. These are managed by professionals who research and invest your money across many companies. You can choose between large cap, mid-cap, small cap, sectoral funds, and so on, depending on your risk profile. And then comes the most underrated option, index funds. These are low-cost funds that simply track the market, like the Nifty 50 or Sensex. They don't try to beat the market. They are the market. And over time, they outperform most actively managed mutual funds. Why? Because they have lower fees and zero emotional decision-making. Now that you know the types, let's talk about risk management. Because risk isn't just about losing money. It's about making emotional decisions that hurt your long-term growth. So how do you reduce risk? First, diversify. Don't invest all your money in one stock or one sector. Spread it across industries, asset classes, and geographies if possible. Second, think long-term. Markets go up and down. That's normal. But over 10, 15, 20 years, they grow. Time in the market always beats timing the market. Third, invest only what you won't need for the next 5 years. That way, you're never forced to sell during a downturn. And now, let's address the biggest myth. You need a lot of money to start. No, you don't. Today, with platforms like Zerodha, Grow, or Upstocks, you can start with as little as 500 or 1,000 rupees. The amount doesn't matter. What matters is that you start, because every day you delay, you're losing potential returns. Now let's talk about some common mistakes beginners make so you can avoid them. Mistake 1. Chasing hot tips. If you're buying a stock just because someone on Twitter or YouTube said so, you're gambling, not investing. Mistake 2. Selling when markets fall. Downturns are part of the game. In fact, they're opportunities to buy great companies at a discount. Mistake 3. Over-diversification. Yes, diversification is important, but owning 30 random stocks you don't understand is just as risky as owning one. Mistake 4. Ignoring inflation. Your savings account might feel safe, but if inflation is 6% and your account gives you 3%, you're losing money every year. Mistake 5. Trying to get rich quickly. The market rewards patience, not speed. Aim for consistent, compounding growth, not overnight wins. Now, let me fulfill the promise I made at the beginning. Here's one of the simplest, most powerful investing strategies used by top investors and completely ignored by most beginners. It's called SIP into index funds. Here's how it works. Pick 1 or 2 index funds like the Nifty 50 or Sensex. Set up a systematic investment plan, a monthly auto debit from your bank. Let's say you invest 5,000 rupees a month. That's 60,000 rupees a year. Over 10 years, you would have invested 6 lakh rupees. But thanks to compounding and market growth, that could grow to 11 to 12 lakhs or more, depending on market conditions. And over 20 years, it could be over 30 lakh rupees. Without ever lifting a finger beyond the first setup. This strategy requires no stock picking, no market timing, no rebalancing, just discipline. It's boring, but it works. And if you want to add some spice, once your corpus grows, you can allocate a small portion, say 10 to 15%, to individual stocks or sectoral funds where you see opportunity. Remember this, you don't have to be smarter than everyone else. You just need to avoid being dumber than the average person in the market. And that comes down to patience, consistency, and keeping your emotions in check. So here's what I want you to take away from this video. Start now, even if it's small. Be consistent. Ignore the noise, and let time and compounding do their magic. If this video gave you clarity, if it helped you see investing differently, hit the like button. Subscribe for more deep, practical content, and comment below. What's stopping you from making your money work for you? Let's talk in the comments, because your financial freedom doesn't start with your next salary. It starts with your next smart decision. Thanks for watching, and I'll see you in the next one.